Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's January 22nd. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So I just got home. I feel like I'm saying that on every Wall Street Unplugged now. I just got home from business trip. So I drove to Miami on Tuesday night, which is 6 hours. Kind of peaceful, though. I drove back last night, getting home around 1 a.m. But I had some amazing meetings. One of them was with Carlos Domingo, who's the founder and CEO of Securitize. So if you're not familiar with that company, they're like the standard in the space. I mean, that's a company we use to launch our security token offering. It's called Curzio Equity Owners. With a 10 token to launch on their platform. They do all the online checks and make sure everyone and every investor is KYC, AML compliant, know your customer, anti-laundering. Make sure that they verify. You have to verify that you're a credit investor. They do this through their amazing platform, make it easy for basically anyone to launch an STO. So everybody that comes to me, even Securitize, especially in the finance industry that are looking to launch these, they'll talk to Securitize and then they'll give me the name and say, hey, Frank, why don't you talk a little bit since you, because having experience in both of these industries, there's not a lot of people that do. And just so many people just want to, and companies have been coming to me saying, listen, we really want to launch STOs. How do we do it? So we're thinking of starting a consulting business and hiring more people for that because that's how big demand has been. But that platform, you get all the information you need. When I say you, it's anyone who's investing and our investors and stuff like that. I have our SAFE agreements on there. SAFE stands for Simple Agreement for Future Equity. It's standard. It's ours about 64 pages, goes over the company, the cap structure, everything. So you see all that stuff. And Securitize now raised over $30 million. I want to say over the last 18 months, might be the last 24 months, $30 million. And the list of investors, high profile. I mean, Coinbase, Blockchain Capital, Nomura, which has over 400 billion assets under management. Mitsui, same thing, over 400 billion assets under management. Santander, over $1 trillion in assets under management. So just Japan, Europe, global, getting bigger and bigger and bigger. And just so many amazing things going on in this industry. And talking to Carlos about STOs and this market, it's kind of like talking to Jamie Dimon if you want to learn about how the consumer is or the banking trends, right? He's like the standard in the industry. That's why it's worth it. He has his pulse on this market. The biggest players in the industry are all investing in him, but just so much positive news and excitement. It's the first time I met him face-to-face. I've talked to him plenty of times on the phone. And it was just a great conversation. He's just telling me the insider trends and what's going on and development. And it was fantastic. Although that meeting was really, really great. My second meeting, which I'll get to in a minute, was in Fort Lauderdale. So I'm driving. I don't know if you guys noticed, I live Amelia Island. Not going to give you my exact address in case one of my stocks go lower. I don't want you knocking on my door. But as north as you can go on the East Coast in Florida, that's where I am. Okay. So going to Fort Lauderdale is about a 4.5 hour drive. Not too bad. And when I talked to Carl, I said, hey, you know what? I'm going to be in the Fort Lauderdale area, have some meetings set up. Do you want to meet? And he said, yeah, definitely. Right. Because we had a meeting planned with somebody else and that person canceled, unfortunately. And, it was a good cancellation. I think he had like a detached retina or something, whatever it was. So Carl, let's still meet. He said, yeah. So I said, I'm going to be in Fort Lauderdale. What works for you? And he's like, well, how about if we have the meeting in Miami? I'm like, oh, it's like another 90-minute drive, right? So I was like, okay. And 90 minutes doesn't seem that far, but when you drive 4.5 already, it's kind of far. So basically I drove from as north as you could possibly go in Florida to almost as south as you could possibly go before hitting the Keys. My second meeting was with the STO market team. So if you're looking to find out security tokens that are free trading, very hard to find, go to stomarket.com. And these guys aren't paying me or anything. I love these guys. Actually, I kind of hate them now that I met them face to face. I mean, their name's Herwig Konings. He's a founding partner at Security Token Group. And you may be familiar with that name because he was my first guest on my new STO Unplugged podcast. Don't worry, it's not taking more time away from me because I talk to all leaders in this industry, and now I just want to press the tape button. This way you got a good idea of what's going on. You're not just hearing it from me. But he was my first guest. So our STO Unplugged podcast, monthly podcast, where I'm going to be interviewing the biggest names in the industry. And yes, it's already on iTunes. And his partner, Kyle Sonlin, who is the co-founder and CEO of Security Token Market. And I say I hate them because they're two young guys, great shape, good looking, motivated as hell, very, very smart. I'm like, man, I miss when I was that young. And it's not that they're really young, but it just the excitement being around that. And they always say, as you get older, if you want to feel younger, you hang around with younger people. It makes a lot of sense because I know there's basketball people. I play basketball with people who are 60 years old and they play like they're 40. And there's people I know at 60 that hang out with 80-year-olds and they can barely walk. So it's just true when you see that excitement, it gets you motivated, just seeing these guys and what they're doing. It was really, really cool because the meetings went fantastic. And the reason why I'm having these meetings, because, ours token, Curzio is going to go free trading in July. So for me, I want to find out as much information, the exchanges, where we're going to go, but just finding ways to collaborate to bring more attention to this incredible industry. That's what we're looking to do because it's an industry that's going to take off. It's taking off now. And when the institutions start coming into this space, which they will, my goal is to have an established brand where they're going to want to partner with us because we're going to be doing all that legwork already. So it's not often where you see a huge growth industry that you can get in early before the institutions, and the institution ask a lot of questions. And the reason why they're not in it is because they want more regulation, right? Because they have the fiduciary responsibility for the assets under management to make sure everything they cross every T, dot every I. So right now they're kind of like, oh, we want to, but we really can. And we're creating different arms to really get in and around it. But once the SEC gets on this, hopefully soon, to really crack down on all the bullshit in crypto, this is a market security tokens. They are securities that is really, really going to take off. And you're starting to see that now. So awesome meetings, just to let you know. And driving down to Miami, I got to say, I'm not a big fan of Miami. It's not because 90% of the people there don't speak English or even the crazy traffic, which is on par with New York City. But it's just a materialistic place. I mean, there's at least 5 Lamborghinis. Every woman is all dialed up. They're beautiful there. But it's like you have to get dialed up. You can't just, roll out of bed and go to the store. No, never. I mean, they have tons of makeup on, and, glasses, nice dresses. And you're looking at the guys where I was in the business district. I would say 60% of the people wearing the suits, or the guys wearing these suits, they were all the same color, light blue and bright pink shirt. Everywhere. And these fancy shoes, dark sunglasses. I mean, Don Johnson was so ahead of the curve, I think, right? I mean, usually styles change over time, not really in Miami, but it's just not my cup of tea. They're having a Super Bowl there. It's going to be crazy. Average ticket is what, $9,500. It's probably even going to go higher. It's just a booming economy in Miami. Lots and lots of rich people. So it's just really not my cup of tea, though. I just like hanging out with people who are cool and just, I don't know, maybe it's just me. But driving down there, I think I got up to 12, maybe 13 people who gave me the finger while I was driving. When it comes to driving there and driving back. And I got to be honest, I don't know what everyone's problem is. I mean, I'm a nice guy. I think I'm a nice guy. A lot of you guys listen to my podcast. I try to help people make money. But if you're on I-95 where the speed limit is 70 and you're in a left lane with little traffic and you're doing 50 with your brights on, I'm going to come up right on your ass. And if you don't move, we're going to swing around you and cut you off. That's how we drive in New York. That's how you're supposed to drive. I mean, it's pretty simple. It's a simple rule. And I know in Florida, it's tough because they don't teach you things like that. They don't teach you things when, whatever your driver's ed class, like to use your blinker. They don't teach you to use a blinker. Watch out for cars around you. No, it's only about you. They'll stop in the middle of the street. They don't even know who's behind them. How the left lane is the passing lane. The left lane is the passing lane. If you're going 120 and someone's behind you, move over. It's the passing lane. It's simple. Or how yellow light does not mean stop immediately. In New York, yellow means speed up before the light turns red. In Florida, it's scary. That's where the most accidents happen. Because that light hits yellow, and I'm talking about a guy that could easily go through that yellow without it turning red. They will hit their brakes as hard as they can. And, I mean, that light is yellow so long, I know I can make it, and I'm behind them very easily without blowing the light. And then when they hit their brake and it's unexpected, that's where you see the most accidents in Florida because they think yellow is stop. Just the way it is. Anyway, some people give me the finger and whatever. I don't care. It's just drive right. Drive right. It's not hard. I'm not asking too much. It's hard to get used to, though. Anyway, It's been really crazy the past few weeks. Always is in January because I attend lots of conferences, always have lots of meetings which require a ton of traveling. And I did want to go to the Vancouver Resource Investment Congress, but I couldn't this year. I mean, my mom is coming home from being ICU rehab for close to 4 months, which I'm excited about. She's supposed to come home a couple of days ago. And I'm here with her in Florida, where the rest of my family's in New York, who come back and forth. But I just want to say thanks so much for all the prayers and support. She's doing much better now. And, that really meant a lot, more than you'll ever know. So I really appreciate all those prayers and all those notes. And I read them all. I really appreciate them. I'm trying to get back to everybody. But we get lots of emails now. We're getting bigger. It's hard to answer, everyone personally. But I really, really appreciate all the feedback and all the support. It meant a lot. But I have to tell you, just in this month alone, I've been going to CES for a full week, going back and forth to see my mom so much. Just came back from South Florida, which was basically a day trip. I've been out of loop a little bit. So, always getting emails, checking in with everybody. You guys know Daniel. Daniel's doing fantastic here, Daniel Creech. And, we'll either call or email. And we was talking about Wrap Technologies. I also took to the management team. But Wrap Technologies popped to a new high. I mean, it's a stock I don't mind giving away for free since my subscribers, most of you own it already at much cheaper prices. But this is the company that created the bowler wrap, which shoots a rope at you just as fast as a gun, and it wraps you up. So it's the first non-lethal gun, not really a gun, device, I should say. And it's starting to be deployed by police departments, not just in America, but all over the world. And it's been an up and down ride for the stock, which I told everyone when they bought it. I said, listen, I've been through Taser. I was one of the few guys out there recommending Taser very early on, low single digits. And again, it went from 5 to 7 to 11, back down to 7. That's the way these companies operate. There's an adoption, there's a manufacturing curve, but everything was in place when we recommended this. I don't have a crystal ball. Management drops the ball here, you're going to lose money. But here's a product that I was one of the first, if not the first, they say I'm the first, that actually, I flew to New York City. I sampled it, had them shoot me with it. We advertised it. And I got it from interviewing some of the top police officials where this saves lives. And this isn't bipartisan bullshit that you're seeing in Washington, right? You have Al Sharpton, I don't care what you think of him, loves the device. You have Republicans, love this device because it saves lives, okay? I don't care what color you are, what race you are, whatever it is. You don't want people to die, and you don't want to pull your gun out and be in that kind of situation. Nobody wins. Even if it's a clean shoot, nobody wins. So avoiding all that with this product just makes sense. And now that they're seeing the orders, just really cool to see that stock pop. I think it popped 17% yesterday. It's just going higher and higher and higher. But, we advertised this. I did a huge promo around it. So we got a lot of subscribers in for the first time. And this is the first stock they bought. And for me, that's the first impression. So I'm really happy to see the stock soaring. I love when you guys make money. That's what this business is supposed to be about. Okay. It's not supposed to be about the editor makes money no matter what the hell his performance is, which unfortunately is the standard in our freaking industry these days. Okay. It really is. You know that. I know that. I'm going to say it. Okay. That's a fact. I know great editors in this industry, and I know horrible ones that don't write anything. Okay. Any of their newsletters, nothing. They're getting promoted. They don't even know what's in their newsletter. And it's sad because their performance are absolutely horrible when the market's near all-time highs. Okay, it shouldn't be about that when it comes to newsletters. You're not subscribing to my service. A lot of these guys, most of them, if not all of them, do not even invest in their own ideas. And they're telling you this stock's going to go up 3,000% in 6 months. If you had a stock that was going to go up 3,000% in 6 months, would you give it to people that you really don't know that well, or would you buy it for yourself? This way you can improve your family life. I mean, you're not allowed to buy a lot of these stocks through other firms. They don't let you. For us, we invested. I'm an investor in Wrap. I'm not selling any of my shares. I held it. I told people, hey, hold it long term. It's a great company. Doesn't mean it's going to go higher. It's doing very, very well now. But for me, I'm happy. I love to see this. I love to see a good company, one that we brought a lot of investors in, where a lot of you listening to this have followed me. So 5 years, 10 years, 20 years, 25 years. I mean, I got people telling me, FXC days with your dad. I used to read your dad's newsletter. I'm not talking about you guys because you guys know the credibility there, like everything. You can track everything that I've done, every podcast online. All of our newsletters are archived. Everything I said, I cover my losers, everything, winners as well, everything. But for new people, for the first time to actually get into this stock and this is what they're promoting, it's just really cool to see. It's really cool. So for me, I haven't sold a share in the stock. I still think it's going a lot higher. You're going to see ups and downs, just like with Taser. Yes, more demand comes in. They're going to have to probably raise money, and they're going to have to, increase that manufacturing. But they have everything in place. They even have hired the guy from the co-founder of CEO of Taser for their CEO, actually their president. So it's amazing to see the pieces that were put in this place, and just from early on when I first recommended this thing, where it wasn't even on the NASDAQ, it wasn't in the Russell 2000. It was trading over the counter to see where they are now in the Russell 2000. This stock really roaring. It's just really nice. But one thing I have to tell you, since I got shot with this device, which I'm sure a lot of you saw that, and we advertise this everywhere, a lot of my friends got into this name. They're like, holy shit, I just saw that. They don't subscribe to my newsletter. It's just like, oh, you like the stock? I'm like, yeah, of course I like the stock. I wouldn't be promoting if I don't like the stock. And they got it at a good price like you guys. And then it was at $3 and it went to $6. And then it fell back to around $3.30 for no reason at all. It just pulled back. Everything was in place. We even had to stop them in Curzio Research Advisory. And I rarely do this. I did it twice in the past 4 years, I think. And once with Citigroup, when Citigroup came down, I said, don't sell it. And that stock's up tremendously for us, especially if you bought it again when I told you to. And also this one, when I said, ignore your stop, $3.30. And this is just in November. And now the stock is trading at $7.50. So when it was at $3.30, I had my friends calling me. They're emailing me. Is everything okay with the stock? Should I sell it? Right, which is common. When a stock goes down, you want to sell it. When it goes higher, you want to buy it. That's the way we're programmed, especially people who are not familiar with the market. And I told them the same thing when they first asked me. I said, look, it's a risky name, but they have all the pieces in place. I think the stock's going to return 5x over the next 5 years, so hold it long term. But none of them listen. None of them. They're going to call me every time it goes down. And now it's trading close to $7.50. They're like, Frank, should I buy more? It's just, and I have to say, it kind of pisses me off because, if you're into the market, right, or if you know a lot about stocks, and a lot of you do who are listening to this podcast, you're going to have people always ask you, hey, what do you like? What do you like? They love that, right? And it's your friends, your family members. Don't ever tell them. Don't ever give them a stock. You know why? For me, when they ask me, I'm like, buy SP 500, man. Market's going higher. That's been my advice. I'll tell you why. Because if you give them a stock and it goes down, they're going to call you every single day. And then if it goes up, they're not going to give you anything. They won't even buy you a beer. So what's the value to me? I mean, people subscribe to news. These are, a couple of friends who aren't subscribers, but it's just funny how there's no upside. If you make them money, they're like, okay, they don't say anything. And if they lose money, they're going to call you every single day. So just be careful if you follow stocks, if you follow the market and family members are asking, don't give them that tip. Everybody has a tip these days with the market going higher and higher and higher. But don't even share it. It doesn't pay. It's a no-win situation for you. It's guaranteed no-win situation. They're not going to share anything with you. They're not even going to, they might say, hey, man, thanks for that pick. That was really cool. What's your next one? But when it goes down, they're all over you. And it's crazy because a lot of my friends don't even subscribe to any of my newsletters. I mean, at least subscribe to Dollar Stock Club. It's a freaking $1 a week for a stock pick. Our track record has been real good over the last 6 months. I mean, really, really good. And these picks come from the professionals, the experts I interview on this podcast, Wall Street Unplugged. You know what? Speaking of experts, today's guest has the top pick in our Dollar Stock Club portfolio. It's up 125% in 6 months. The stock is Luck and Coffee. The analyst is Andrew Horowitz. Andrew's a great guy, known for a long time. Hosts a Disciplined Investor podcast, which is the second best financial podcast in the world behind this one. He also manages money through Horowitz Company, one of your favorite analysts, one is mine as well. Again, we go back a long way. Andrew's a great, great friend. And today he's going to break down the markets that keep going higher and higher and higher and how to play them. He's going to talk about the coronavirus, which has infected hundreds of people in China. Now there's one case in the U.S. So what are the implications? And not in a bad way, right? We're just going to say, if you have some of these stocks in your portfolio, which he outlines, and I love this segment I'm going to talk about, he's going to tell you, just be careful. And these are big names that are in China that trade in the U.S. that could get impacted. He's also going to break down earnings season thus far, which has been pretty strong, even though we're still early in the season. And last but not least, Andrew is going to give his favorite stocks to buy right now. And guys, pay attention because Andrew has been red hot, at least over the past 18 months, now that I'm tracking these portfolios and these stock picks for my guests and the ones that I put in Dollar Stock Club. And he's been red hot. So definitely pay attention. Then in my educational segment, I'm going to break down one of the most hated sectors. Hated sector, no doubt about it. I'm not talking about gold. I'm not talking about uranium. I'm not talking about mining. No, it's not that. There's another hated sector where it's just people don't want to buy stocks in it for some reason. Can't blame them because this sector has come down tremendously over the past couple of years. And why it's about to see a massive turnaround starting right now. And of course, I'm going to share my favorite ways to play the trend, as there's a lot of depressed names. Some of them are hanging in there, doing okay, maybe 15% off their highs, 10% off their highs, but more 20, 30% off their highs. These are names that can easily pop 30, 40% in less than 6 months because they're super depressed, especially with this data on this sector is going to turn positive. It's going to start. It's actually starting a little bit now. Not too many people are talking about it. And it's going to go on for 2020, 2021, 2022. And a lot of these names are going to rebound sharply. Again, I'll share a lot of those names with you in a few. But first, let's get to my interview with the one and only Andrew Horowitz. Andrew Horowitz, thanks so much for coming back on the podcast.
Hey, Frank Curzio, you made it back from Vegas.
Yeah, it was a lot of fun, man. I thought you
awesome.
Actually, you mentioned that you might come this year, and I thought you might. A couple other friends met us there, but it was really cool. Great technology, a lot of fun, and we took videos, a lot of that stuff. Some of them, jump in water in a wetsuit. The visuals were bad with me in the wetsuit, but it was really cool. It was a lot of fun, man.
It provided me hours of laughter. That one part. No, it was great. Point. I mean, your tracking of that information, the live feeds on Twitter stream and all that I mean, there was some really cool stuff there, and that was really great. I want to seriously thank you for doing that, because I felt in a way that kind of I was there, obviously not for the parties, but for the education of the technology that was coming up.
Yeah, I appreciate that, and that's the goal, and it's really cool. They're going for 8 years, and it's been awesome. So next year, that's it. You come on.
Okay, I'm there.
All right, yeah. Cool. You're gonna be jumping in the wetsuit.
Oh, that's ugly. Oh, that's bad.
All right, let's get to the markets here. The markets continue to hit new highs, pretty close to new highs. We have a lot of positive things in the favor. I won't even go over all of them because everybody gets told them every single day if you're watching CNBC, because most of those guys on there, they're traders, and when the market goes higher, they love the market. When the market goes lower, they don't like the market. What are your thoughts right now? I mean, everybody that I talk to is very, very bullish. It's hard not to be bullish, but what concerns you? Because we should be concerned when everybody's leaning to one side, which is the case right now. Almost everybody's bullish.
And it's interesting because I always look at the idea, the concept, the visual of when everybody's on one side of a boat, right? You know, everybody's like, oh, let's look at that. And what happens? The boat starts leaning. And then all of a sudden it leans to a point, it gets a little bit too much. Everybody starts racing that's not the problem, because it's controlled. As slowly and surely as everybody gets to that one side of the boat, it's when everybody races to the other side. And that happens when you have things like a concern about, Momo getting into FOMO, which we've had recently. And everybody says, hey, you know what? I need to be in this. Why? Well, because it's going up. And everybody's racing to that side. Now we're starting to get that boat tipping a little bit towards that. As you mentioned, we have incredible amounts of bullish sentiment out there. And if you ask people, well, why are you buying? Well, they don't give you, fundamentals look good. No, it's all about, the Fed is priming the pump, or, the markets are just going up, so I need to be in there. I don't want to miss out. So the sentiment is really towards the bullish side, which is fine. It could last a long period of time. And as you said, there are a lot of good things, and particularly because many of the headwinds, the roadblocks that were there, that were building up throughout 2019, even though the market was going up, were kind of just evaporated towards the end of the year. We got a trade deal, which was crap, let's be honest, and I could talk about that if you want. But there was a resolution, so everybody's like, okay, that's done. There is no change of tariffs, no change of really anything except for a promise to really buy and a few other items in terms of access to Chinese markets. With the Brexit supposedly happening at the end of January, we have, the impeachment, which is okay, it's done now. What? Well, pretty much it's going to vote along party lines. That's a done deal. So a lot of the issues that were really out there disappeared. That wall of worry no longer was there. There was no longer any roadblock. Everybody's like, okay, well, if that's the case, let's get going. The thing that is, I think, most troubling, if there is something, if you were to say, Andrew, what is that the markets are discounting all bad news. There is, you look at Boeing stock. Boeing is looking for a $10 billion loan. They are needing that to make up for shortfalls potentially on costs related to the delay and all the things that are going on with the 737 MAX. On top of liability exposure they have. Yeah, they have money in the bank, but they're going to borrow it. It was initially $5 billion, now it's $10 billion. Stocks, hovering around 300 and we'll call it, I don't know, $10 a share, give or take. And this stock was up last year. Could you imagine if this was any other name out there? And there's some reason why it really didn't get hurt. But this is a company that put $43 billion into share buybacks over the last, I think, 7 years. Now, I think Boeing should be ashamed of that and should have actually put a little bit more of their money into safety and to innovation rather than just worrying about share price. But that's another story. So I think that the markets are discounting a lot of all the bad news, really. And there's clearly these buy programs that are at work. If you look at the markets, 9:30 in the morning, it's the Pavlovian response. The bell goes off and markets move higher, regardless of where futures were. And we know the Fed is pumping in liquidity. I think the biggest issue right now is what happens if all of a sudden sentiment changes, says, this is like the coronavirus. Maybe this is something. And if the Fed, if the Fed stops priming the markets, they put another $25 billion into the overnight lending markets again last week. And I don't even understand why. Do you understand why?
I don't, but you know what? This is a good topic. I didn't want to cover it so much because we got so much to talk about, including the coronavirus. But what I want investors to understand is you have to put your feelings aside. I don't, if you're like, the Fed's printing money, gold's going to go higher, buy a little bit of gold. That's okay. You've been doing that for a while. A lot of people have been shouting at the top saying, you got to buy gold. But you have to realize we don't really agree with this. And you're right. I don't, why is it another 15? Why did they keep pumping more and more money into it? But you have to realize that they're pumping more money into the market. That's it, period. Right. So if they're doing that and they're keeping interest rates low, every asset's going to go higher. You could argue it, write yourself a sign, go in front of the Fed, do whatever you want. But money-wise, don't fight it. And I understand the emotions out there. But when I see people out there going, oh, you got to buy gold, the Fed's destroying the country. They're not, whatever. Maybe that happens 50 years from now. I don't know. But you have to, the trend is lower interest rates and the Fed keeps pumping money into the market. And that's why you're seeing not just stocks, every asset price.
Every asset.
Is going higher, and you have to realize that. So don't get your personal feelings, because we talk about it all the time. Like, why would you do this? Why are you buying back stock? Why? The bottom line is when you buy back stock, it's good. Stocks go higher. Stocks go higher because of that. So you could say, well, they should spend on R&D. You're right. They should have spent it on safety with Boeing. I agree. But you just can't fight it. So you don't want to get your emotions involved too much, right? And I think that's why so many people have trouble buying this market, especially if they're gold bugs, where they're like, oh, it's going to, it's just the environment.
Hyperinflation.
Yeah. And it does. And that's another thing too, right, Andrew? Because everyone says, well, inflation. Listen, every single bill I pay, everyone who listens to this pays, every single bill, everything has gone higher over the last 5 years, 3 years, 2 years, last year, right? We see inflation. Doesn't matter. The Fed looks at the CPI. And the CPI is hovering around 2. And now they even say, well, if it goes even above 2%, a little bit higher than 2%, we're going to be fine. We're going to keep interest rates low. That's the only thing you need to be concerned about when it comes to stock.
On that, you know what they did? They recently went to a new process of looking at their CPI target. They look at a couple different inflation gauges, CPE, CPI. But basically, if you look at this, the CPI, for example, one of the things they had is a target of 2%. Why they had this 2% target and why the rest of the world adopted, who knows? But that's what it is. And what they said recently, as a matter of fact, I was at a lunch with Bernanke about, 8 months ago. He talked about, hey, you know what? I think the Fed's going to start doing this averaging process where they're going to look at historic, maybe over the last year. And if it was at, let's say, 1.5, and now we're at 2.25. We're over the target, but yet they're going to average out and look at this saying, we can overshoot because it's been short of this for some time. And remember something, Frank, you don't have to remember something. The Fed is in the business of pumping markets in the economy. That's their job. Is it, they have any other job?
No.
No, they have nothing else. They'll slow down the economy, but they'd much rather speed it up. Point, though, is that you asked me, where are the issues? If the Fed stops and starts pulling out money or stops their process of funding the repo market and the short-term treasury and the overnight lending market, that's an issue for liquidity. I think the market is totally, there's other reasons too, but a big part of what's going on right now is liquidity that has been flushed into the markets. It finds its way down into equities and risk assets. And on top of that, the share buybacks estimated to be about $420 billion this year by Goldman recently. So those are the things you really need to look out for that we know of. Then the is what we don't know, like the coronavirus.
And talk about that, because I mean, are people going to look at this? Because I mean, we saw, we heard about SARS, we heard about Zika, we heard Ebola, that the world's going to end. Don't go outside. I mean, it's so extreme and so much fear behind it.
Mm-hmm.
It kind of reminds me of, and this might be definitely not an apples to apples comparison, but it's kind of like the government shutdown when it first happened. The market crashed. Everyone was worried. Yep. Then you had another one. Now it's a blip on the radar if it closes, even for a week or two. It's like, don't worry about it. We've been through that. Are people going to start looking at this where there's one case in the U.S., there's hundreds of cases in China, but is this that much of a scare? Or it's scary because if this thing spreads, it's insane and holy cow. But is it going to influence stocks in the markets? And, you give me a list of topics all the time or things that we want to hit on. This is one of them. But I love where you were going with it because from an investment point of view, if you own stocks within certain sectors, why don't you go over that where this could impact those? Yeah.
So first of all, the coronavirus is not a disease that is somehow contracted from drinking too much beer. Let's just get that straight, okay?
Yes.
It is a pneumonia-like virus, and it's right during flu season, and it's bad timing right now because China's New Year period is now. Now, remember something: when China gets a flu or a cold, it's potentially really bad. The concentration of people in that country and how close they live to each other, and some other issues related to the country itself. I mean, it could spread very quickly, and that's why they're always on alert. The big issues you're really going to have are if you add this timing of this to the Chinese New Year, also add to the mix here Hong Kong protest, the direct hit on tourism, for example, and confidence in the region. You may be having some problems with areas like the casinos in Macau, other travel-related stocks, hotels and airlines. There is going to be the potential for a very significant hit. Because if people don't travel, particularly in Japan during this year, if they're not really moving and moving out of China because of some kind of limitations, if this does spread, if this does get a little out of control, there could be a problem in the Asian region during this period because it's a very big time for China. So, I mean, the answer to the other question you had is, will this just be a blip? It's always a blip, and it's always kind of controlled until it isn't. Already, Kuroda from Japan is like, don't worry about it. Like the central banker of Japan is somehow now a scientist and a health minister. This is how ridiculous it is, right? Making sure the markets don't react because they kind of cut down a little bit recently in Asia. I don't know where this goes and how this progressive and if it metastasizes into something much greater or I don't know. But, the thing you need to be aware of is that you need to be alert to this. You need to be aware of where it's going, what may happen, and just kind of, realize that in the past, yes, these kind of situations have been transitory, have been temporary in nature. Even the Ebola scare that happened, right? It was temporary in nature. And there will be some kind of, with modern day medicine, some kind of a cure or something that will happen there. Maybe look at some of the companies like that produce masks and clothing related to containment. There's a couple of companies that are wild names like Lakeland Industries, APT is another one. But that's totally speculation. The only thing you have that for is if things get out of hand, those stocks will probably rally pretty good on that. But if it all falls down and nothing happens, maybe a biotech here or there will come up with some kind of a cure for this.
Yeah, it's interesting. I just like when you say the travel-related stocks that are related to China, which are big names that trade in the U.S. are Wynn, MGM, Sands, right? Those are the ones that have licenses to build in Macau, and that's definitely going to impact them. So, just something to look at. And again, there's much more important things, but if those are in your portfolio as well, we just want to highlight that. But let's move on to earnings season because thus far it's been pretty solid, right?
Yep.
Well, it's almost like we see this every earnings season.
It's
I don't
same.
know why the analysts don't get it. It's just like, hey, we're not going to see growth. And then almost 70% of the companies wind up beating every single time, 70, 75. It's always like the same statistics. You'd think that, they'd raise estimates. But, right, earnings season has been pretty good. This guy, a lot more clarity.
Wait, hold on. Earnings season is good compared to analysts' estimates, right? I mean, that's what we're talking about.
But that's all that matters, right?
It all that matters, right? Because nobody looks at growth. Growth is relatively flat on EPS, and revenue has been okay. It's coming in. It's not been terrible. Well, for the most part, overall, banks have been doing well. It's amazing. There's been a little bit of a split in the banking area.
Yeah,
some companies like a Morgan Stanley, like wow. Well, Morgan Stanley was really on their announcement of their profit estimates moving forwards and their profitability. So that was that. A couple of banks in Bank of America, okay. Goldman Sachs, Wells Fargo, not so good, which probably is par for the course there. I mean, they didn't get hit very bad, but they still have a lot of buybacks coming out. Their balance sheets are, looking great. JP Morgan, what can you say bad about that name, right? But so the banks are looking pretty good. We saw IBM come out actually beating estimates a little bit. Actually, the first quarter and 10 quarters or 15 quarters that they actually had a revenue increase on a year-over-year basis. I think some of that has to do with the Red Hat acquisition potentially, but that's interesting to note. Netflix does what it does. It goes below, it goes above. They're all over the place, right? We don't know exactly what's what. They're changing their statistics on watching. I don't know if you know this. It used to be if you watched 70% of a show, it was considered watched. Now it's if you looked at it for 2 minutes, it was an intentional, and they'll count that as a watch.
That's interesting, right? Because when it comes to our podcast statistics, what Apple did, it's kind of the reverse, right? Because all the numbers went down 30, 40%. I think the way they started tracking it, I think it was 4 or 5 years ago. And it was, I don't know if they have to listen to a certain amount of time or how long it is, but it's weird in the podcast industry. It's kind of opposite, where everything else is, hey, just, if you DVR it and it's automatically that you're watching it, I guess, right? Even though you might not watch it, even though it's taped, maybe you don't ever watch it.
Well, how about when you fall asleep watching a Netflix series and it just keeps on going, going till the end? You wake up in the morning, you're on season 5. You're like, wait, I went to sleep on season 2. How did that work?
That's so great. That is so great. Yep, everybody's been there. You're binging, you watch it 4 or 5 shows, and boom, you think my wife passed out. Next thing you know, it's like the 3rd, 4th, 5th season. Damn.
Right. Gotta go back. Right. Gotta go back. But I mean, buybacks are good. I mean, U.S. economy is still on reasonable footing, 2.25%, GDP growth. Maybe the question mark again is Boeing. That with all the things that are going on, they may shave off about 50 basis points off of GDP in 2020. Will that be temporary? Potentially. Who knows what's going to happen with the 737? What's going to happen? Already we're seeing some consolidation of their suppliers. Some companies are coming together because they're having some problems there. So we have this kind of bifurcated economy. I think mainly due to the tariff drag, right? The tariff drag with regard to manufacturing, which is clearly in a recession. But all else services, which is about 70% of the U.S. economy, is doing well. Consumers kind of holding up pretty well. And one of the big things with consumers, we've had this generational shift in how spending occurs, right? So it used to be, I don't know, take whatever generation you want. There was, the generation of the Cadillac generation. What you wear, what you have is all important. Then we got into the next generation, which more of experiential. Then there's another generation just all about savings. There's another one all about just eating. So it's kind of rotated around of what is the industry. But right now what we have is a generation that is not so much consumed with what they have as opposed to what they have done. That's kind of where we are now. It reminds me of almost my grandparents and all that. They always would have money stuffed in all sorts of places around, and they would live very much for the next generation, right? Well, they would save and all that. Why? I want to give it to my kids. I'm like, oh, okay, that's interesting. Kind of progress now. It's like the younger people these days are spending everything they have, figuring that one day they're going to get money from their parents, I guess, or somehow things will just work out when they get into their 40s and 50s. So there's kind of a change in the spending habits and what's important in the economy right now. And I think that is really reflective in how there is this major bifurcation between manufacturing and services. I think that's what's kind of going on right now.
Yeah, because we have seen a decline in manufacturing. It's been a drag since 2018. Obviously, it was from China. Now things, with China, it's more that at least that every time Trump talks, and even in China they talk, they're saying how good the relationships are. And I think that sentiment-wise, it's very, very good. Even though there wasn't really that much done, but it's better than saying, hey, if they don't do this, we're going to do this. And I think, that changes in terms of sentiment. But the manufacturing sector has been underperforming. I mean, you can see that in statistics. I know you cover it, but it's interesting in how everything's going to services. It's why Microsoft, all these services, recurring revenue, Office, you got to buy it every year. Just everything's a cloud now. It's, Adobe, all these companies like that.
Your
services.
Your car. You're going to be able to have a car on subscription.
Everything's subscription. Yeah.
Cars.
Yeah, it's crazy.
You buy a car and you buy a subscription. You could turn it in like your iPhone, and when the next model year comes out.
Yep. It's great.
So what that is going to create is a world of us being tied to our subscriptions. No longer do we have ownership of anything. Going to be interesting.
Yeah, it is interesting. It's definitely happening. So let's get to some of the stocks, because there's the latest 2 stock picks that you picked, and you've been red hot. So one of them was Facebook. You said that you didn't like it short, and that came down a little bit, I think around 15%. But you also gave us Luckin Coffee.
But then it went up a bit. Yeah, then it went up a bit, and it's kind of hovering about 8% underwater from kind of where that was, but we got some nice trading on that. But yes, Luckin Coffee it's up 125%. We track some of these things, our Dollar Stock Club newsletter now, some of the picks. That's been the number 1 pick in our portfolio. Wow.
And it has your name right next to it.
Wow.
So it's really cool, which is
very
awesome.
Nice.
And listen, I got to give you credit's due. And you've been red hot almost every single time you've come on this podcast. So everyone's interested. Even me.
I'm so jinxed.
I know. I'm going to short whatever you say right now. Everybody just short this stuff.
Oh, man, the pressure, Frank, the pressure. So a couple of names. Cool, I'm a little bit late on this one because it's had a major run up. I invest in this personally because it's kind of a name that is not really appropriate for our portfolios, even our aggressive portfolios. But it's interesting because why I want to talk to you about it was that it's something that's like, okay, well, what's going on there? And it's a company called Virgin Galactic. Virgin Galactic, its symbol is SPCE. And it's gone from, if you look at the chart, it's a bizarre chart. It's been $10 forever. I mean, it's like it didn't really actually trade. And then it dropped down to about 7 or so. It's up, I don't know, it's up 75% in the last month and a half. And this is a company that is owned partially in an adjunct from Richard Branson, who I love. And it is his venture into commercial space travel. And it's an interesting thing because, you have Elon Musk, for example, with SpaceX, a few other companies, working on the whole space area and the potential for Space Force that we see. And by the way, why does Space Force uniforms that came out, why are they in camouflage? Because what do you need camouflage in space for? Just a point. But you have an interesting opportunity here where maybe we're going to have space travel for fun, going up, maybe visiting the upper atmospheres. And I don't know what we're doing. We're cruising around. We're doing something. Anyway, they're building this. And I think there's a lot of interest. Is this the next level of travel of sorts? So SPCE has been interesting. This stock has been on fire. That's why I'm saying we may be a little bit late on this. This is pretty much the only pure play on retail space travel that's out there that I could see.
You know what? I like Rich. Everybody that I know that has been in contact with him, I've talked to people who work for him. He's one of the billionaires that are really, really cool.
Yeah.
I
hang out with him.
Working for that guy. They just said every time you're around him, he's just energetic. He's fun. You don't have guys like, Patrick Byrne leaving the country, selling his stuff. All these crazy, McAfee. It's just, guys that even Elon Musk, these guys, I like the fact that they're out there. They have to be out there. That's why they're successful at doing things against the grain. But this is the one guy that seems like everybody that comes in contact with him, they just want to do business with him. They like him. And he's like a young kid at heart, entrepreneur still. It's just, and he's always done good for his shareholders. So
how much would you give to be a fly on the wall at a weekend away with Byrne and McAfee?
Yeah,
that would be something.
That would be crazy. I mean, unlimited money and unlimited crazy. It's
totally unlimited crazy.
Oh man, that's a scary
that's kind of an interesting one. The other one is Crocs. this is something I didn't like for years. This is a company that way back when they came out, they were one of the high flyers. And we were talking about them. As a matter of fact, you can go back to like 2000. I don't know what year it was, but I was all over Crocs as being the biggest POS piece of crap out there. And stock came down dramatically. And as a matter of fact, looked like for a little while there, a couple of years back, that this is done. This is done.
From 70 to $1 in 2008. So 70 was pretty much the high in October 2007. I'm looking at it now, and then it went down to $1 and change in 08.
Yep. And then it's been kind of it really stabilized, came up to normal levels from the oversold levels, and it's been firing on all cylinders. Great turnaround story, new product line, a lot of interest back in the brand, really good products, moving to multi-year highs not seen since 2007, by the way. Recently, and there's not a great amount of short interest. Sometimes you want to have that as potentially an additional way for this to kind of catch a little upside opportunity. But it's hitting our fundamental screens as a solid growth story on consistency of earnings, for example, consistency of revenues, and growth of revenues and margin expansion. That's hitting my core screen. So this is not like a spec play. This is a core position in our portfolios for the TDI managed growth strategy. And it's been doing great. And it's really surprising to me, to be honest with you. But I think maybe the whole shoe world, when you look at what's going on with many of these shoe companies, and particularly those that are like unique and have a unique brand line. I don't know if you have Crocs, but everybody that has Crocs that I know loves them.
I was just going to say that, guys. I mean, Andrew just threw out tons of stats. I could tell you that it's trading at 21 times forward earnings, which is not a big deal because the company is growing. So I wouldn't say that's expensive. It's growing very, very fast now. Generating tons of cash flow of $100 million in operating cash flow. We could throw out a million statistics, but as an investor, sometimes it's that easy because everybody I talk to that has Crocs, they love them. And unfortunately, I've been in the hospital with my mom. She's finally better for the last 3-4 months. I probably saw literally hundreds of nurses
in the hospital. Yeah,
all of them wear Crocs.
Right.
All of them love them. They're all comfortable. I mean,
plus they have antibacterial properties also. That's important for the hospitals.
Yeah, it's just people get so caught up. It's like the Tesla cars, right? Every time someone sees a Tesla, they turn. I turn my head. When you have a good product and you're thinking about shorting something, be very, very careful shorting a company whose product everybody loves because it winds up killing you. And I'm not saying this is a short, whatever. I agree with you, but everybody that I talk to loves this brand. They're now signing celebrities. It's a different company from back then.
Right.
Like 2008, 9, 10. But now, I mean, look, they are firing all cylinders right now. And I think there is more upside. I definitely agree with you with Crocs. Yep.
Yep. And then as a matter of fact, you think about cars that turn your head. The one that turns my head all the time is Aston Martin. I had the opportunity just last week at a grand opening of a dealership down here that I was invited to as a Rolls-Royce, Bentley, Aston Martin. I'm like, they're like, do you want to go to the grand opening? I'm like, yeah, it was a big party. So I had the opportunity to spend some time with the CEO of Aston Martin United States. And I was talking to her a little bit and I said, look at your stock and I look at the stocks of Ferrari and all that. And she had some explanation of it because the stock is not doing so well, but that's a head turner, the Aston, like the Tesla. The other stock I want to mention, there's one thing I want to just remind me to just mention one thing about PEG ratio before we finish here, because I think that's something really important.
Because I know we have to finish. It's funny.
Yeah, I got a couple of minutes on this, but the PDD, and I cannot pronounce this, so I'm going to butcher this. It's Pinduoduo. Pindodo. It looks like Pindodo. It is a shopping and social company in China. Some people say it's the Amazon of China. I don't really think it's exactly like the Amazon of China because you have other companies like that, although Alibaba is not really the Amazon of China either. But there's a few others similar to this, but they're a shopping and social-oriented retail site. If China's markets recover and there's a bit of relief from this overhang with consumer confidence and tariffs and all this, I think this could be a winner. It's another name that has a pretty wide trading range, but interesting name overall to take a look at.
Yeah, I'll finish up with PDD, guys. Yep. PDD. Yeah, it's okay. Okay.
I'll finish that with PEG ratio. So I did a report recently on the PEG ratio, which is a better way to look at things on a stock-by-stock basis and a market basis than just PE ratio, because PE ratio is pretty much a one-number, very simple calculation. It's two-dimensional. The PEG ratio is a bit three-dimensional. So it takes the PE ratio and compares it to the 5-year analyst estimates of growth moving forward. So you get more of a ratio that is comparable to its own self. So you're looking at PE of a 15. Well, what does that mean? I don't know. It's 15. I can say, well, historically it's been that, but what about the other names in the sector, et cetera? A PEG ratio of 1 is considered fairly valued. The PE ratio lines up with its forward 5-year earnings estimates moving forward and growth rate. And then a 1 is a 1-to-1 ratio. These days, when you look at the market overall, the S&P 500, it's at 1.82. Now, that means that historically the PEG ratio of the S&P trades about 1.2-ish, up and down from there. It goes to
that
0.8.
is high. That is very high. I'm surprised at that number.
High. It's very high. It was 0.8 back in December of 2018. So you can see that got pretty low. And then it kind of leveled off a little bit. Now it's gone ballistic. So one of a few things are going to happen here. The first thing is people are going to realize that they're paying about 30 or 40% over the future earnings estimates for companies right now on an index basis, right? That's not one company, it's the whole index. And some companies are even higher than that. You get over 2, you start scratching your head a little bit because that's really getting outside the range. But you're really outside the range right now. And again, you could say, well, that's because interest rates are low and the Fed is priming and this and that and analysts this. All I'm saying is that is the other part of that top part of the discussion we had about what issues could be out there. And I think people are generally overpaying for equities right now, even with lower rates, even with everything, because even if we have these 5-year growth rates that are expected to be decent for companies, we're still paying, again, 20, 30, depending on it, 40% over what the average S&P levels are. And that's something that concerns me.
I didn't know it was that high. I'm actually doing research on that right now just to see, where is that in line.
Pull up Yardini's research. He does a weekly piece on that.
Yeah, because that is, that's very, very interesting just to see. Just surprised it's just coming off of the year tax reforms. But next year, there's a lot of expectations of huge growth, right? I mean, there's expectations for next year, very high growth. So let's see if the company could do that. They're not going to do that if there's fighting with trade, especially in China and Europe, that's for sure. But it is interesting. That's a great number. So covered a lot. I know you're busy. Thank you so much for coming on because I know we had a tight window to do this interview and I love it. So if someone wants to find out anything about you, your podcast, anything at all of how great Andrew Horowitz is, how could they do that?
Let me give him your cell phone number. Hang on a second. You could go over to thedisciplinedinvestor.com. We do a podcast each and every week where you have some great guests on. We had a great guest on last week talking about fundamental analysis. We've been talking, of course, of Frank Curzio quite often. You could do that. Find it on iTunes. Just look up my name. But those are the ways you could check out all the different strategies that we have, from a $10,000 minimum with Investology up to $500,000 minimum with our global allocations, and a long short strategy, $50,000 minimum with TDI managed growth strategy. So thedisciplinedinvestor.com will give you everything and everywhere you need to look for what that is. And finally, my Twitter handle is Andrew Horowitz, one word. So follow me there. That's where I kind of post everything up of what's going on.
All right. Sounds great, bud. So listen, get to your meetings. Thank you so much for coming on. And of course, I'll talk to you soon.
All right, Frank. Thanks.
All right, buddy. Hey, guys. Great stuff from Andrew. Love him. We have this unwritten rule that we always go on each other's podcasts if we're busy, if he leaves me last minute. And not that I need him last minute, but, I was traveling and it's been a little over 3 months since he's been on. So on Monday, I'm like, hey, bud, could you come on? I'm going to get home on Wednesday. I got a Tuesday night, explained earlier from my trip to Florida, South Florida. And he's like, sure, I could do it. I could do it between 10:30 and 11 o'clock. That was the only time for him. Like, all right, I guess we're doing it 10:30 to 11. But it's really cool. And we always do that for each other. But I know he's one of your favorite guests because we go everywhere. He talks about the economy, talks about so many different parts of the market. It's really, really cool. And his picks have been red hot. So again, I always say this podcast is about you, not about me. So let me know what you thought about that interview at frank@curzioresearch.com. That's frank@curzioresearch.com. Now, let's get to my educational segment. Going to talk politics a little bit really quick. So I'm going to piss off probably some of the audience. But the reason why is because it has to do with the stock market. Because what are we seeing right now is this impeachment nonsense, right? And I say it's nonsense because there's no way this is going to pass through the Senate, even if they had strong evidence, and they don't. And I won't go over it. You guys know it, right? I mean, we showed the transcripts. We have the presidents of both countries saying no, there's no whatever it is, but they just have to bring this out. Again, anything they could do to bring us, I think it's backfiring tremendously mean, so the Davos speech by Donald Trump, and look, I don't care if you're a Donald Trump fan. I don't care if you're not. For me, when it comes to politics, I like to be fair. And when we look at the economy, even the New York Times has said positive things. Even Andrew Sorkin said positive things and said, hey, 3 years ago, no one knew if this was going to happen, or they doubted it and they were wrong. Okay, the economy's doing good on almost every single measure. That's fine. But then I'm coming home and I'm listening to Hannity because it just happened to be the radio station. I don't listen to him often. Sometimes I listen to CNN. It's just, you can't really get anything unbiased anymore. And he was talking about all the accomplishments of Donald Trump. And then he was going, and we're energy independent. I'm like, all right, take it easy. We're not energy independent because of Donald Trump. Okay, that was, I wouldn't say the Obama administration, but 2006, 7, 8. I mean, that's when we really started shale oil drilling, really started hitting 2009, 10. I covered this trend, but just don't go too far. And that's what's wrong with politics today. It's okay to admit some things are good about different candidates. I mean, Obama did a couple of great things. I didn't agree with all his policies, but same with Trump. If you hate him, you hate him. That's fine. But what he's done for the economy is incredible, and you got to give him credit for it. That's fine. I mean, maybe I don't know what's going to happen over the next few months. And something drastic has to happen because I really think this impeachment is really blown up in their face. I think people are just sick of it. It's nonsense. It just showcases, even on both sides, how much these people are just power hungry. They have to be in power. I mean, it has nothing to do with the American people. They don't give a shit about us. It's power. We need the power. And it's so great that this is highlighted even through social media. Anyway, the point I'm making here, again, I probably pissed off people no matter what you say, you're going to piss off people in politics these days, is the impeachment, which most people think is a joke. It's a complete waste of time. And you're looking at the economy. It's a strong case for Trump to win, probably in a landslide later this year, unless something dramatic happens. And when I look at him winning the presidency, what does that mean? And I'm not talking about what happens in the House or the Senate or, I'm just talking about Trump being the president, what's going to happen. One of the biggest trends that I've seen take place is the massive decline in manufacturing. And if you look at the manufacturing survey trackers from Goldman Sachs, which does a great job, just talking to the biggest players in manufacturing infrastructure, stuff like that. You're looking at the actual numbers. It's been horrible since when? Pretty much since March 2018, which is not a coincidence, right? Because that's when the tariff and the trade garbage and all this news, trade wars, that's when it started with China. And it's been a free fall. I mean, even till today. Maybe not till today, but up to 2 months ago. So almost through 2019, manufacturing has been a big drag. And I tell you, Andrew touched on it earlier, okay, with the trade deal and phase one. And I know people are trashing it and saying it's a lot of nonsense. It's horseshit, okay, when it comes to your portfolio. It's a big deal because we now have positive sentiment. That's the most important thing, okay? You don't have Trump saying, I'm going to do this if. You don't have China saying, I'm going to do this if, and we're going to You're not seeing that. Now, the president speaking at Davos saying, I have a great relationship with China. China's saying, wow, things are good with the U.S. That's a big deal because now business is going to get done. Now, what does that mean for manufacturing companies? What does it mean for a lot of these companies that have global exposure? Now you're going to see a lot of companies get a little bit more aggressive and say, okay, if this is not a risk and we're getting along, now I don't have to worry as much. I don't have to be so conservative. That's very, very important. As someone who follows earnings, very few companies were raising guidance. Unless you have U.S. exposure or your technology company with a certain niche that, stream, whatever it is, it's doing well and you're adding subscribers. But when they do most of their business globally and everything going on with China and also with Europe, just trade tensions, plus Europe hasn't really been great. Any region, almost every region. I mean, there's no way these management teams, these CEOs could actually issue a positive forecast. There's just too much uncertainty, right? I always explain that to you guys. The biggest risk on a stock, on the markets, is uncertainty. Investors hate it. They run to the exits when you have uncertainty. That's why when a company's getting sued for many, many years, the stock gradually goes down. Once they settle, no matter what they settle for, as long as they don't completely, go bankrupt and ruin the business. As soon as they sell, that stock's going to go up 15, 20% because there's not a risk anymore. You just took a major risk and that uncertainty was lifted. That's huge. Right now, the uncertainty is lifted off of China. Maybe we have problems later on, maybe phase 2 to deal with, but right now that's really good. And that's going to result in manufacturing turning around. What does that mean? If you are a Curzio Venture Opportunity subscriber, I just recommend a manufacturing company, which is a technology company. I explain these statistics to you, why it's important, because this company got nailed because they saw a huge decrease in business from Asia and Europe, especially over the past few quarters. Now, this stock got hit pretty hard. And if you're looking at China and Europe, if they just stabilize, which not only are they going to stabilize, you're going to see the manufacturing do better and better and better, and these trends go higher. But once this happens, you're going to see so much money flowing into so many infrastructure and manufacturing companies. And a lot of these names in this sector are trading off their highs, well off their highs. Fluor is one FLR. Jacobs Engineering, not as much. Quanta Services and Cummins have been holding up pretty well, right? They're trading close to the high end of their range, but not really like blowouts but these are companies that are going to see massive inflows of money. Building supply companies, Martin Marietta Materials, MLM is a symbol. Vulcan Materials, VMC, Eagle Materials. These companies have been doing okay. They've been doing okay. The high end of their trading range, they're going to see a boom in business. They're going to start seeing that growth component come back. And you can get in early. Just like, listen, we're getting into early. We're ahead of the street on everything. Okay? It's nice to recommend IBM. And people now are talking, wow, IBM, good quarter. It's great. It's great. When we were buying it, everybody thought I was a complete idiot. All right. Same with Ford. Ford's going to do incredible because it's a technology company. And people look at Ford and say, it's a shitty company. It was for 5 years. It was terrible. I get it. They're not even going to be a car company 2-3 years from now. Everything's going to SUVs, electronic vehicles. That's what they're selling. Some very few cars because everybody's buying SUVs and crossovers. And they're positioned themselves. They have some of the best technology in the space. But people just look in the past and think, well, that's why the stock's been trading crappy and it's down and we're able to get it cheap. Wrap Technologies, I mentioned earlier. I want you to get in before the world knows about these things because that's when you make the greatest gains. And it's an amazing feeling to see that you're in a stock that people gave you shit on. And then 6 months later, a year later, everyone at CNBC loves it. And you're sitting there, it's up 60-70%. They're like, you should buy it. It's the greatest feeling in the world. It is. We're seeing that with a lot of our stocks. Not that I recommend stocks that are completely out of favor, just sometimes. Now, how do you know which stocks to buy without trying to catch a falling knife? Insider buying is a big tip. And that's huge. It's a big tell. If insiders know everything about the company, they're buying their shares. That's a very, very good sign. Doesn't mean it can't go lower. It may go lower, but they see earnings come, especially if the stock's down 40%, 30%. It's nice to see that. You're looking at earnings. You're looking at depressed levels. You see the short ratio really high. Just everybody who hates the stock, like Tesla, everyone who hated it was already short. You couldn't get any more. It's just to see that stock take off and blow up in so many people's faces. It's not a surprise. Maybe it comes down later, but when everyone's leaning to one side, usually the opposite happens. All the time. Not even usually, all the time. But start looking at these companies. I mean, even 3M, there's a reason why GE is going high, even with their Boeing exposure. And Boeing, look, Boeing's a stock we recommended. We're down about 10% on. And they're coming out with just, bad news all the time, the emails and stuff like that. Look, Boeing's going to be over $500 in 3 years from now. Okay? It's around 310, whatever. It's around 310 now. It's going to be over $500 3 years from now, easily. Okay? It can go lower in the short term. It could. Yeah, but they're going to get the MAX jet back in the air. Might take a little bit longer than expected. But those orders for the MAX jet, they're not going anywhere. There's no competition. Only Airbus, who's at full capacity. And these planes are going to save billions for these companies, for these airlines that they ordered over the life of their fleet. Because they're lightweight, 25% more efficient. So it's not like, oh, wow, this company really messed up and now the competition comes into and just eats them up. There's no competition. Nobody's going to start making airplanes anytime soon. Sorry. Unless you have $25 billion for the facility, which most people don't. Most people. These days, it might be a little bit easier to get, considering Jeff Bezos and how much he's worth and Bill Gates these days. But you get my point. So those headlines are going to be negative. That's fine. And maybe it comes down a little bit more. But I know that this stock's going to go up tremendously once they figure this out. It's like Chipotle did. But getting back to the material stocks, a lot of them are out of favor. Even the ones that are trading close to the higher range, they're going to see business take off. Okay, because Europe is getting better as well. We're seeing strength out of Europe for the first time in a long time. Our relationship with Europe, much better than it was 6 months ago. Still a little bit of work to do. China is much better. But you're looking at manufacturing, you're looking at the data. It's fell off a cliff since early 2018. And the last 2 months, you're finally seeing the uptick. Even in the Goldman Sachs survey, pay attention to that survey. Also pay attention to Bank of America inflows, outflows. When I see firms covering things and talking to the biggest companies, and they've been doing this for 15, 20 years, that's who you want to pay attention to. They've been through the ups and downs. They really know these markets better than everybody. They know the top people in these markets. They know who's full of shit and who's not full of shit. Who's aggressive, who's not aggressive. It's all factored in. But even looking at Goldman Sachs surveys, seeing that, hey, you know what? We're starting to see an uptick. It's very, very early. Nobody's talking about it. And a lot of these names are going to go higher, which is cool because we're in a market that a lot of stocks are trading at all-time highs. It's not easy to find, that diamond in the rough, especially a mid-cap, large cap that you can get at a big discount right now. It's not easy. This is an area where you can find lots of great stocks that have tons of upside potential as this trend turns. So be sure to sign up to my Curzio Research YouTube page. It's absolutely for free, but I have some amazing videos, which Andrew talked about earlier, and that's for the CES. Just sampling tons of new technology, product, gadgets, and also I'm breaking down each trend from the floor of the CES. I have lots of live feeds that I had when I was there where it just felt like you were there. It was really, really cool. And also we're going to start doing a lot more videos that we're going to be posting to that site. Just a lot of people are subscribing. It's getting bigger and bigger. I didn't realize we all know YouTube's a great platform, but for us, it's been very, very good. Facebook wasn't so good. Twitter's really good. And now we're seeing just YouTube. People like videos. I like doing the videos. I don't mind. I like doing them when unscripted. I hate scripted things. I like when it's unscripted. It's just, if you know your shit, it's very easy to do. And it's just, I don't care if I make a mistake. It's fun. It's directly to you guys. So you're going to see all that stuff on YouTube. Short videos. Some of them are a little bit longer. But trust me, the ones that are even a little bit longer, which are not many, they're filled with great data, and it's going to be entertaining. It's going to be cool. You're going to hear a different perspective than what you're hearing out there. And you can get all that for free just by signing up to our Curzio Research YouTube page. So guys, that's it for me. Thanks so much for listening. Really appreciate all the support, guys. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.